Okay, we'll go ahead and kick this thing off here. Welcome, everybody. Good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Trading Coach's Corner. My name is Brandon Wendell, as the screen says. And let's see, hang on a second. Sorry, I got a bunch of computers beeping at me all over the place on my phone, too. Just crazy day, busy day. So, but it's a good day, and it's Friday. And we're here to get some education, learn more about the markets and what we can do to potentially profit from them, whether it's income or looking for wealth building. A lot of people turn towards options for those, and that's what I'm going to talk about today. I actually do run a program. Actually, before we get started, I need to do one thing, and that is remind us that we are not broker dealers or investment advisors. We're going to be looking at the markets, possibly. Actually, we will, but we're going to do it from an educational standpoint. So I'm not giving any personalized recommendations or telling you to buy, sell, or hold anything. And obviously, there's always risk of loss in the markets. We can only try to minimize the risk and manage it. We can't eliminate it. Also, we're not subject to trading restrictions. We got positions in a security, initiate one at any time. So let's see. Welcome, Brenda. Good morning, Helen. Good afternoon, Kevin. Welcome, welcome, welcome. I said that got a lot of things going on. One of the programs that I'm really involved with, it's actually every single day. Now, it's not on the list right there, but it's called the SPX Cash Flow Secrets Program. And I'll talk a little bit about that. That's my options program. I actually have on the members section here. That's what it looks like. You see there's a bunch of educational videos in the members area, documents that support the education. I track all the results and it's updated April. There's bonus videos for education and there's SMS texts that go out every day with trade information, ideas basically for options. And that's what I do is I look at the SPX and I look to generate income by doing credit spreads on the SPX with 0 days till expiration, or what they call 0 DTE. So, we'll cover a little bit about that, but I just want to kind of explain where I'm coming from and why I'm qualified to talk about these things because I'm an option trader, but more so that I focus on them on a regular basis. So you can also stay in touch with us. We're obviously active on all the socials. I'm actually pretty active on Twitter as well, X. You got to change the logo, I guess, too, because that's wrong. But, I'm busy on X pretty much every day. My handle there is Trader B-Dub. And be careful because there are people out there. Let me see, X at Trader B-Dub. There's people that have been trying to copy me, creating fake accounts, saying they're me and trying to steal money from people. It's horrible. So don't fall prey to that. I don't ask you for money through socials, things like that. I don't ask for money at all, period. I talk about subscriptions if you're interested in looking to join me for education, but that's about it. So be careful out there. Anyway, these are a lot of the classes I teach, but I mentioned I'm going to talk a little bit about that SPX cash flow because it kind of goes with what we're talking about today, which is options. So yeah, there's the link if you're interested in learning more about it. You can also email us at support@Wealth Builders. See if I can take this all out. HQ.com. I think I typed that right. So anyway, yeah, we're going to talk a little bit about options, obviously. And oh, that's weird. Kind of all disappeared. I was looking at TradeStation. I also have my TOS open here, Thinkorswim, if I can get to the right page. And basically what it comes down to is we need to figure out when we're trading and trying to profit from options, is it more advantageous or beneficial to trade on the long side or the short side? We could do either because when you think about it, actually, let me go here and bring up this. When it comes to options are pretty simple. There's only 2 types of options and really only 2 things you can do with them. And good morning, Stephen. Welcome. The 2 options are calls and puts, and you can only buy them or sell them. So a call option, if you're not familiar, basically what they are coupons. If you get a coupon, it allows you to buy something at a discounted price, even if the price of that product goes higher. And that's all a call option does. It gives you the right to buy a stock, ETF, or even futures. There's options on futures too. So that gives you, if you buy that call option, you're basically bullish on price because you're expecting that value to go up. But instead of actually getting the security at the lower price, most people, when they trade options, end up selling the options at a higher price. The value of the option goes up more than what they paid for it. So they sell the option. They sell the coupon to someone else, basically. So that's one way of doing it. And if you think about the seller of that call option, they're actually the opposite. They're bearish. And they sold you that call option thinking you're never going to use it. You're never going to need it. And the reason why is if the value of that security goes below the coupon value, there's no need to use the coupon. The coupon expires worthless, and the seller gets to keep the money that you paid them for buying that option. That's it. Back in I guess it was late 80s, early 90s, dating myself a little. Back in high school, we used to sell for fundraisers these entertainment booklets. I don't know if you guys remember those or had those. It was a booklet, probably close to 700 pages filled with coupons and a little card that came with it, and coupons for things like car washes, restaurants, all sorts of things. I lived in Pennsylvania, so they had stuff for Hershey Park or Dorney Park or what was the other one? Action Park. That was a fun one. I don't know. I think they closed that because I don't think they could have that open in these days. Action Park. If you went to Action Park and didn't break a bone, you didn't have enough fun. Anyway, Barry remembers the entertainment cards. You would pay, I think it was like $49.95 for the booklet. You paid for the coupons. If you never used any of the coupons, you lost your $49.95. You lose it anyway, but if you get to use the coupons, you actually got some value out of it. That's what an option is, a call option. It's simply coupons you pay for. A put option is like car insurance. You bought a few of those coupon books over the years, Kevin? Nice. Yeah. I sold a bunch. I had a bunch too. I bought them too. But a put option is kind of like insurance. You pay a premium over and over and over again. And if you wreck your car, theoretically, you get to sell your car to the insurance company for the value it was before you crashed it. That's it. That's a put option. If your stock crashes, you bought the right to sell your stock at a higher price, the strike price, even though it's collapsed, even though it's crashed. So that's all a put option is. Your insurance company wants you to drive safely and keep paying them that premium. Obviously, if you're a higher risk, they'll take in more premium than somebody who is a lower risk, a safe driver. That's all. So we got coupons and car insurance. And again, there's 4 different selections. You get buy calls, sell calls, buy puts, sell puts. And what we start to do then is create what are called spreads. And spreads are nothing more than combinations of these two. And the reason why we might combine those is, well, perhaps we don't know which way prices are going to go. They could go very far up or very far down. Well, we'd want to select a green arrow and a red arrow. Well, if you did both, you could see we could profit in either direction. Or what if we think prices are not going anywhere? Pick a red arrow and a green arrow. And it could go horizontal, where you buy a call and sell a call, or sell a call, sell a put, or buy a put, sell a put, or buy a call, buy a put. Again, you could make any kind of combination here to create what it is you're really looking for out of that particular position. That's why options are so cool. There's so many combinations. It's so flexible. It's got a lot of flexibility. If I could speak English today, there's so much flexibility with them that you can create these really cool opportunities. Now, I was talking about, the difference between buying them and selling them. And when it comes to this, basically, a lot of people look at selling options as not something they want to get into, because typically when you sell options, excuse me, your potential profit can sometimes be less than the risk you're taking in the position. And that doesn't seem smart, does it? But the reason why that works out and why people would want to do that is because of the probability of that position working. When you buy a call, for instance, you only profit if prices move up far enough and fast enough, because you're working against time and you paid for that coupon. So you have to go beyond that in value to get your money back and then profit, right? You got to go beyond the break-even point, which would be whatever you paid for the option plus the strike price, or the other way around, the strike price plus the price of the option. Easy way to see it as I'm explaining it. Where are you? Option Station Pro. Again, I could use different platforms for this, but been playing around with TradeStation for a while, so it's easier for me to see some of these. I'm in a delayed data situation here. That's fine. It'll still work, hopefully. And I got Apple, so I'll just use that for now. So let's see. I'll just use this one. Doesn't matter. Right now, we're trading $190 on Apple. It's going to populate my options. Maybe, maybe not. And I'll click on one, see what happens. Yeah, it's not going to give it to me. Okay, hold on. We'll fix this real quick. Or I can use my other platform, the Toss, which I'll use both. You hit go to Toss. Yeah, I can do either one. Like I said, that'll log in while I'm waiting for it to log in again. Yeah, I can go, excuse me, trade rather than waiting forever. So we got limited time. Heck, I'll use crude oil. I mean, options on futures work just as well. So if I'm going out for a little bit of time here, let's go September. And let's do a simple single option. Currently, crude oil. Let's see, it's going to be the September contract because that's the one that expires then. And it's currently trading at 76.56. So if we think this is going up, we could buy the 76.50 call. There it is. And the price right now, excuse me, is $3.67. And if I go to analyze this, you see, it doesn't change over, does it? Got to add a simulated trade. Got to do it again. September 76.50 call. There we go. Risk profile. And there it is. So basically, because I'm paying for this, you can see that I'm in a negative position until I reach, basically my break even is about what, 80.18, somewhere around there, where I cross over that zero line and actually start making profits. Okay. And I haven't really adjusted this. That's why I was looking at TradeStation, because I could see things a little better. But again, platform doesn't matter. But this has to go far enough and fast enough to make a profit. Well, when you turn and sell that option, there's actually more probability because you have three ways of making profits. One, obviously, if prices go down, because you get to keep the premium if the coupon is not usable. But this can also profit if prices go sideways as long as they don't go above the strike price. And lastly, you can actually profit even if prices do go up, as long as they don't go beyond the strike price you sold. So again, going back to this call, instead of buying, let's see, we'll go a little higher. We'll go to 78 and I'll change it if I can. There it is, sell. And once again, you can see I profit if prices obviously stay below the $78 point, but they can keep going up as long as they don't go beyond 80.98, which is my break even point. That's at expiration, obviously, not at current price. But I have room to the upside. I have room to the downside. And if it even just goes sideways from where prices are now, I still profit. So I have a higher probability of profit. A lot of people will look at something called the delta. And let's see if I go to add simulated trades. Do I have the columns? No. There we go. In probabilities, and right here it shows probability of out of the money and shows the deltas. So if I look at that call option, the 76.5, the delta is 0.53. Probability of that being out of the money is 47.62%. We'll call it 48%, just to make it easy. That means I have a 52% chance of it being in the money. That doesn't mean it's going to be beyond my profit point, beyond the break even though. That probability might be a little bit lower. This is before expiration. Now, if I were to sell, and what was I selling? The 78? Need some more strikes there. With the 78 option, the delta is 0.47. I have a about a 54% chance, so a little higher probability of this expiring out of the money, right? Because I only had what? I had 52% versus 54%. It's not that much of a difference here, but obviously I could choose different strikes and increase the probabilities. So going back, you can see I've got three ways to potentially profit from selling a call, but only one way when I buy. It has to move far enough and fast enough. Same thing with a put. If you buy a put, you've got to have the prices move down far enough and fast enough because time is eroding your value, and you have to go beyond what you paid or the premium for that put option. Well, when you sell a put, obviously you profit if prices go up because the put expires worthless. But again, if it goes sideways or even down, it doesn't matter. You could still profit from selling that put. So there are more opportunities, more ways for a short option to be profitable versus a long option, even though the profits are not usually as large. So since I got my trade station loaded up, let me go back there. Option Station Pro. I don't think I had it open still. No, good. I'm just a little more versed on the options on this one. I know Toss is very good for options, and so is TradeStation. There's a lot of great platforms out there. I don't care which one you use as long as you're comfortable with it, really. So again, I'm looking at Apple. There we got pricing. And again, if we're looking at prices possibly going down, I could buy a put. And let's see, we're at 190 right now. If I were to buy that put, $3.95 and analyze it, you can see what did I do here? Now, let me change my chart a little bit with the graph. I only need two. So we'll do now and expiration. So at expiration, you can see prices have to be below roughly 185.97. Let's see where it is exactly. I don't have to do exact, but expiration. There. So it has to go down to 168.10. Yeah, 186.10, excuse me. Let me see. Enlarge. Yeah, 186.10 is where it has to go before I can actually make any or break even. Before I make any profit, it's got to go below that. And it has to do it, obviously, before the expiration of the option. If it doesn't, well, I might lose some money. Yeah, what did I do there? This is the June one. So I'm going to erase the old one. There we go. That's better. Anyway, if I were to sell a put rather than buy, change this over. The risk profile changes once again. And, well, this is not the one I'd want to sell. Probably do a different strike. Let's say I do 195. Nope, still not profitable. 200. Oh, these look expensive. Maybe I have the wrong price there. So hold on. Back to trade. Sell. 195. What's it giving me for price? There we go. Analyze. Get rid of the first one. And there we are. So yeah, now you can see that as long as prices don't move up too much, I profit. If it either stays the same, goes down, or goes up a little bit, then I have a higher probability of profit. Right there, the delta is 64. That means there's a 64% chance of it finishing in the money. Okay, so that means I will likely profit at expiration as long as prices stay below that strike. If I did the long, I forgot to see what the delta was on that. Actually, if I go back to options, there's my delta, and I was doing the 190 call, or I'm sorry, no, I was doing puts, 190 put. Delta is 0.46, a 46% chance of it finishing in the money. But remember, I needed to go down to at least 186, and you can see the delta on that 185 put is only 28% chance of that finishing in the money. So I had a much lower probability of that option working by buying it versus selling. Now, that's just one factor when it comes to trading. Obviously, we want higher probability, and it's not always the best opportunity to go ahead and sell options. Just because you might have a better delta doesn't mean that's what you want to do. One of the biggest impacts on options trading, and actually, I'm trying to remember, there's a good website I used to use. Yeah, I'll remember it afterwards, I'm sure. But anyway, one of the things that you really need to think of when it comes to options is this premium, right? And this premium is made up of two things. You have what's called intrinsic value, and you have what is called time value. Intrinsic value means that option is in the money. It would be advantageous to exercise at this point. Think of the 190 call. The 190 call, we're actually trading 15 to, we'll call it 20 cents above 190. That means if you had a coupon for $190, you could buy Apple roughly 20 cents below what it's currently trading at. Therefore, it's in the money. You would not want to exercise the 192.50 and buy there because you could buy it in the market cheaper, $190, right? So you see in TradeStation, they colored in gray. Those are in the money calls. In the money puts are the opposite. You want prices to be below those strikes. So that's where the gray is. Okay. Now, if you notice, the profit intrinsically for 190 call is only about 20 cents roughly, right? Now it's dropping. Why is this trading at $4.65? Well, anything above intrinsic value is time value. And by the way, it's not just time. There's a few other things that get involved with this besides just time. So keep that in mind. They call it time value to give it something simple, but it is much more than just time, as I said. And I'll explain what it is in a moment. Okay, sorry. Keep looking at my phone. So intrinsic value, by the way, now it's only down to about 5 or 6 cents, right? It's the difference between the current price and the strike price, but you cannot go negative. That 190 call is now no longer in the money because prices went below 190. You do not have negative intrinsic value. It's impossible. It's either zero or a positive value. If prices go below, basically you have zero intrinsic value. And right now I've got $4.55 of time value. Well, time value is made up, like I said, of a group of things. It's time until expiration. It's volatility, which is basically time is theta, T, volatility, V for Vega. We have gamma, and actually some delta in there as well, directional. It actually attributes a little bit to, or contributes a little to that time value, and a little bit of rho, which is interest rate sensitivity. I don't have all those in. Let's see. Columns. What am I missing here? Rho. Nobody really cares too much about that. We have gamma. And do I have all the Greeks? Yeah, 5 Greeks. There they are. So I have the columns. And like I said, rho, it doesn't change much because that's if the Fed changes interest rates, that's how it affects those options. It'll either go up or down with the interest rates. Gamma is a rate of acceleration. And there are some good things you could do with gamma. There's gamma squeezes, gamma plays, all sorts of things. But basically, gamma tells us how much delta will change. So again, it's a rate of acceleration of the premium. And delta is directional movement. For every $1, the underlying price goes up or down. That's how much the premium should change. So looking at the time value, that's one of the reasons why you might want to sell options versus buying options, because you're going to play that time value. And that time value is basically made up, as I said, theta and vega are the two main ones. I'm going to get rid of the gamma and rho again because we don't really need to focus on those. There's extra columns. There we go. And I'm going to change the symbol actually. Go to SPXW. Whoops, I forgot the X. .X. There we go. Okay, sorry about that. And this is the S&P 500 index options. I can bring it up on TOS as well. Under SPX, I believe. Should show me the options there. There's the index and loading up. You'll notice with these options, there are options expiring or available pretty much every day. We have the ones expiring today, Monday, Tuesday, Wednesday, Thursday, Friday, next Monday, and so on. So those are called weeklies. Even though they're not expiring every week, they actually expire every day now. There are some that still do weeklies. And the reason why I bring this up is this is something that I keep an eye on a regular basis. Again, for the SPX cash flow secrets. Where's my other browser? There it is. And it's not this chart that I want. It is my SPX chart right here. So one of the things I look to do, well, first of all, I got to delete all those zones that got blown through. And I track zones going back months. You know, if I keep going back and zoom out, you'll see May 6th. I don't even know when this one was. May 3rd. April, February. Yeah, I got some zones from way, way back that still have not been tested yet. So I've been tracking this for a while. But basically, what I can do with the selling of options is generate some potential income by selling where I expect prices not to go. And once again, I have higher probability because I'll profit if prices either move in the direction away from that, stay in the same level, or maybe even move a little against me. Excuse me. And let me bring up, rather than looking at this one for now, let me see if I have, where is it? There it is, cash flow. I do all my screenshots. Excuse me. Apologies, my allergies are going nuts today. This was yesterday, for instance, in the chart that I was using. And you see, this is before the end of the day, right around 2 p.m. I analyze where I expect prices not to go beyond. And then, let's see, was this? Oh, I have it on my phone. I didn't bring it up here, I think. Yeah, this is one of the options that I was looking at, was selling the 52.15, 52.20, 52.70, 52.75, and that is an iron condor. Basically, what would happen with this particular strategy is selling two options and then protecting myself and limiting risk by buying two further out options. You can see the little green shaded area. This is Tastyworks, by the way. And in that green shaded area, anywhere in that realm, that range, is where prices would profit, basically between the two strikes that were sold. If it goes outside of that, that's where the losses begin. But there is a maximum loss. Let's see. In this case, max profit was $35 with a max loss $465. Doesn't sound great, does it? Doesn't sound smart. But we can place a stop loss, as I mentioned, to protect ourselves so we do not have to suffer the maximum risk. I mean, you take a look at what happened yesterday. Well, I deleted that one. Let's see. 52.23 to 26 was the 15-minute zone. It's right about here. 23 to 26. So that's where that zone was. You can see prices came close. The options that were being sold were 52.20, so they never went in the money. And by the end of the day, we were able to keep the premium. And then the other trade that was put on was the bear call spread, which I think I have showing here as well. Oh, actually, this one. Yep. Oops, wrong one. There we go. Selling 52.70, 52.75, collecting 45 cents. Okay, again, the maximum risk was $455. However, probability of profit was 84 cents. I'm sorry, 84%. And it actually got better because what happened was, as soon as that trade was sent out via text, price dropped, never got close to that supply zone. So it was a pretty good opportunity to collect premium, again, with higher probability. But as I was getting back to and kind of alluding at, you don't necessarily want to automatically sell options. For instance, if we're looking for today, and I'm not giving any suggestions here. Again, I got to do some more analysis on this to see where the stronger zones are as well as the trend. So I'm not giving a recommendation. I'm just picking some numbers, for example. If we expect prices to stay below 52.18, I could go out and buy options. And if prices keep moving down, those options may go up in value and I could profit. The problem with buying options in that scenario is this. You could see that I have 1 day left, actually less than a day, right? A few hours left until these expire. The time decay is going to erode the value of those options almost to zero by the time I try to exit in the afternoon. So if I buy options, I need to buy a lot of time. And this is a mistake that a lot of traders make. They try to get into a position cheap. Let's go back to a normal stock like Apple or Tesla, whatever. It doesn't matter which stock. Again, if I look and I want to trade because I think this is going to go up, we have two choices: either buy a call, sell puts, or some other strategies as well. Buying a call, if I did a shorter time frame expiration, these options will be cheaper. Let's say we're doing the 180 calls. Well, actually, no, I'll do 190 because that's at the money. So the 190 calls, what I'm looking to buy, you'd pay $4.70 per share times 100. That's $470 to get into that position, right? Make sure that I do just one. Yeah, I'm saying 465 roughly. So anyway, I'll put it at 470. There we go. And that's my max loss. Okay, the problem is the time decay, it's 11 cents per day, even if prices move nowhere. And the other thing is I got to check the volatility, because if I buy options with high volatility, I might be overpaying. Okay. Volatility affects the value of options probably more than anything else. If I go to analyze this option, okay, let me get rid of the other one that I had here. There we are. So just this option, and I'll use the last price or current price. Actually, let me lock it in at 190.20. Otherwise, it'll keep changing. So right now, let's see what says. Oh, that's an expiration. Sorry. Let's go now. Wrong one. This is currently. It says that the value, it's about 468. Okay. So I have no profit, no loss right now. Pretty much break even if I were to sell this right now. But if volatility goes up by 5%, I'm making profits on the long. But if volatility drops, let's say by 5%, I lose almost $100 out of my $468 position. That's a pretty good chunk of my premium that I lose. Prices didn't go anywhere, but volatility dropped. Why would volatility drop? Often when prices go up, volatility tends to go down. So buying a call, expecting to profit, even if prices go up, let's say this goes up $1. I'm still negative 34.50. So what about 8% of my entire value of my position? Because volatility dropped, even though it was right on the direction. So you got to be careful of that, because if you're expecting to get out of this, and let's say prices go up even further, let's say we were really right and it went up to $200, but it goes up and volatility dropped by 15%. You'll still make money, but not as much as you could have if you probably chose the right strategy at the right time. Changing the volatility back. Remember, there was about a $600 profit. Putting volatility back to zero, you make an extra over $100, or about $100. So you get a better rate of return on your money, an extra 25% almost, based on choosing the right strategy at the right time. So if I were to go back to, let's see, I'll do it on TradeStation. I think I have it open. Oops, get rid of these. Okay, come on. There it is. And it deleted this. Let me go into studies, and I'll add a couple studies here. Now, these are not necessarily the best studies to use, but they're available, and there's different ones on different platforms, of course. Let's see, I want to brighten that a little more. Oh, style. Let's see, do this one and make that the default. Perfect. This is implied volatility of the options, and it also shows the average behind it, which I forgot to change as well. I want to thicken that line a little bit. I'll leave the color same. There we go. And basically, if our implied volatility is above the average, options may be overpriced. Now, not necessarily extremely overpriced, and there's varying degrees of above the average. Another thing I can use is comparing what we call historic volatility with that implied volatility. You basically have two types of volatility. Okay. You have implied volatility, which is basically telling us where the prices might be going in the future. And you have historical volatility, which is pretty much a chart. It tells you what prices, how they've moved in the past. So if I compare those two, implied versus historic volatility, and again, I'll go ahead and thicken the line. It'll change colors automatically for me. You'll see that when this line is very high, implied volatility is much higher than historic. Well, what happens with price and pretty much with volatility as well, we have what's called reversion to the mean. Whatever is happening, if we get extremes in price movement or volatility movement, they normally will revert back to the average. They'll come back. And that's something that we can look for when it comes to options trading. Okay, so overall, when we're trading options, for instance, you see text, how big is that going to be? Whoops, what happened? Oh, it's there. Come on. Oh, I know what's wrong. Snap mode. There we go. Oh. Off. Is it off now? There we go. Sorry. was trying to fix this text in the font. It's not letting me get the menu. Come on, there we go. Edit. Thank you. Style. That's colors fine. Font. All right. That's a little better. Anyway, high volatility, expensive options. Typically low volatility, cheaper options. It's not guaranteed because there are some other factors from time to time. And people always ask me, okay, so what is high volatility? What is low volatility? Well, it depends. We're looking at the volatility on USO. That's an ETF. We're currently actually above the average a little bit right here. Let's, can I raise that? There we go. You can see that we're above the average. The average right now is 24.75%. We're currently at 26.83%. But that may not be very high when you compare to Apple. And actually, maybe it is. Where is Apple right now? That's showing -1%. That's got to be wrong. Let's try Tesla. I think I'm getting bad readings there. Oops. TSLA. It might happen because I got so many different platforms and stuff open right now. This is not populating yet. Oh, options data unavailable. Oh, great. Okay. Anyway, I was trying to point out that volatility numbers will be different depending on what it is you're trading. And why is this? Oh, well. And of course, it's not cooperating with me today. Go back to USO where I have my text. There we go. And what I was going to put in here as well is we're dealing with implied volatility. And that is the expected price movement going forward. Historic volatility is the price movement that we've already had. Okay, and that's the other side. Historic. Sometimes you see it called statistical. And spelled wrong again. Statistical volatility is past price movement. So what you'll see is, again, right here, when we're extremely high in volatility, implied volatility versus historic, we'll normally try to snap back to the average. It could go a little further before it snaps back, but overall, it should snap back. And the same thing when you're looking at implied volatility versus an average, there may be times where it moves away and then snaps back. Each security is going to be a little bit different. And you can also see in an options chain, if I go here on TOS, I'm sorry, not TOS, on TradeStation, if I go back, here's Apple, and currently the implied volatility, usually you want to compare on maybe on the last 30 days right there, you can see the current implied volatility is 22.54%. Well, I'd have to check a chart to see if that's high or low compared to average. Also, what's shown here, plus 9.53, plus or minus, that's the expected price movement from right now, $190, will either go up roughly $9.50 or down $9.50 by the time that option expires on June 28th. So they give you the implied volatility and what it should register or transfer into for price movement. And that could go into some of your decisions, especially if you're selling options. If you think that there's a good resistance or supply zone, $9.50 above or $10 above, and you can get enough premium by selling that at 200, there's a pretty good probability that you won't go past that and you get to keep the premium. Now, it's not guaranteed, but there's a higher probability if you're outside that expected range. And of course, ranges change. You can see the numbers are fluctuating even as we look at them. So I'm sure there's stuff on TOS as well that show a lot of that stuff. I just don't know where everything is. You see, if I go to USO, Again, this is showing implied volatility right here for each of the options, and it's different for each option as well as the series of options. And they have it here too. So I was looking at Apple on the previous example on TradeStation, right? And I was looking at June 28th, and you can see the implied volatility 24.46 plus or minus 10 and a quarter. So it might be slightly different, but it's pretty similar. We had on TradeStation June 28th, yeah, 22.5%, 954 versus a little bit higher. But again, you get the same information, what the volatility is. Now, how do we know if that's high or low? Again, we could chart. And I took the liberty of bringing up implied volatility here. And let's see, this is high-low volatility. I was trying to see different indicators and what might help me identify what is high or low volatility. You know, I found the one on TradeStation pretty easily because I've used that before. There we go, Apple. And relative volatility index, you can see this is an indicator that shows if we have extremely high or extremely low volatility. This is just general implied volatility. I don't know if I can apply an average to that. Doesn't look like it. So just got to find an indicator or a study that works for you that helps you identify whether or not you're high or low in the normal volatility range. There's several of these out here. I just don't know, like I said, which one is probably the best. And there may be others you can download on the internet as well. Like I said, I was using the ones on TradeStation. I know where they are. Just looking here, let's see. That looks like that's low implied, but high historic, and vice versa, maybe. Because I'm noticing when there's spikes in implied volatility, this indicator goes to the bottom. So that may be when you want to sell options. Here's where you'd want to buy options because that, let's see, edit. And it doesn't tell me exactly. If I go to more details, it'll probably tell me what the indicator is actually reading. Yeah, right there. But again, I don't want to bore you guys and go into all that right now. You can do it on your own. But for the most part, when implied volatility is relatively high, option selling is typically better. When it's low, it's the opposite. And we can actually test that. We have right here, what date is this? 4/19. And let's see. One of the cool tools that I have available here, the heck is, oh, there it is. I couldn't find the tool I was looking for, drawing the line there. So right there, you see the implied volatility is relatively high compared to where it is now, right? And excuse me. Well, I guess we were close to a little support. It wasn't really at a demand area, but we were close to an area where when prices were at this point before, they rallied, right? So if you recall, there's two choices that we have now. Oh, went too far. Right here. Oh, I could have kept it this way. If we expect prices to go up, we can either buy a call or we could sell puts, right? Those are two possible choices. We could sell a bull put spread, or we could buy a call, or even do a bull call spread. A couple choices there. So we can examine those and go back to see, this was on what day? I said the 19th of April. And we were trading at approximately 165 bucks. So if I go back to analyze, we have what's called think back. And I'll put in Apple. There we are. And I'm going to go back to that date, which was April 19th. There we are. And the cool thing is, it's going to show me going back, and there's my chart. I don't really need that at this moment, but I can go back to see what the options were priced at on that particular day and kind of back test this to see which would have been the better strategy, right? Which one had a higher probability, which one would have possibly paid out a better rate of return. And with volatility being high, you typically are going to have expensive options that are likely to be dropping in value if the volatility drops. So let's take a look at buying the call. Now, when you think about buying a call, one of the things I mentioned, I didn't actually follow the whole thing with my thought process there. I apologize. But one of the problems that you have, that's not it. There we go. Yeah, that'll work. is that people try to buy cheap options, right? We were at what, $165 that day? 167.04 is where it closed. So 165 calls are 685 right now if we buy them. The problem is we only have 28 days left till expiration, so the time decay might eat up a lot of those profits. So typically, if you're going to be trading on the long side, debit side, you need to buy time. And even though that's only $685, if we go out further, now the 165s are 1075. We're paying $4 or $400 more for those options. Right? About, oh yeah, if you wanted today's, that's right. That's right. So 419, I did have to go out further. But my point is that the theta decay, even though you're paying more for that option by going out further in time, it will decay slower. And you think of this extra payment as a deposit. Because the time value is not going to erode as much when you sell your option, you should be able to retain and get back a lot of that premium. So we need to find an option that will be long enough in expiration that when we exit from the position, once we hit our target, we should still have more than 30 days until expiration. So if we're getting out today on the 31st, we want to make sure that from today, we are trading something that still has 30 days left till expiration, because time value is not linear on the decay. It's exponential, it curves. And the last 30 days, that theta picks up quickly. You know, right here, the 165s, they had 17 cents of decay with only 2 weeks left. Here, 165 only has 6 cents of decay for every day, right? So we may be looking at least at the June 21st. It's still within 30 days from today. So July, that's probably the right one. So we could buy the 165 call July for $10.65 per share, or if I put in that trade, it'd be $165, right? I'm sorry, not 100, 1,065 times 100 shares. Now, the alternative to this position would be to sell puts, again, as we're expecting prices to go up or slightly up, but the volatility to drop and time to decay. So that's an alternative that we could do. And let's see, if I go to vertical, see if it lets me do both at the same time. I'm not sure. Let's see, we want to get out 31st of May, which is today for the expiration. So there we go. And if we got in on that day, we have the 165, 160 put. There it is, sell that. That's connecting them both, isn't it? I'll have to do them separately. Oops. Sorry. So I'm gonna, oh yeah, there we go. Delete the whole thing. Start over. Single. July 165. And what I'll do is write this down. 1075. It's saying 1065. I guess it's shaving it a little bit. That's fine. So now as we go through this, you can see it's showing me how much profit I'm getting in this position. And it's not guaranteed that this is going to work out better, but typically when options are high in volatility and dropping, you can typically profit better. Not always, but you can often profit better by selling rather than buying. So here we are now. I've moved forward to 531. There's the profit, 1610. So that's a pretty good profit, right? Let me see your calculator, because I hate doing math. We profited over 100% because we got 1610 out of that divided by the initial 1065. And that's 151% rate of return. That's pretty darn good, isn't it? Okay, well, let's take a look at the other side here. If we sold rather than bought, April 19th, there we go. Going back to a vertical spread and choosing the options that expired today. Now, the maximum profit on this will be $170. That's it, because I can't profit more than the premium I'm collecting. So I already know that we're getting 170. And in this case, we are going to get a better return by buying the option, buying the call option. But what if prices didn't reach that target? and they didn't reach in time. That's one of the conditions that we have to worry about. Here, we sell for 170. That means that we have to put up a margin because we're collecting that premium, 170 credit. But the difference between the two strikes is $5. We took in 170 in premium. That means we have to come up with $330 of margin for our broker to allow us to do this. If you're not sure and you want to check it, you can just go to trade. Delete that one. And where was it? Nope. Well, May 31st. It would have been back then. It's not going to show right now, actually. That's okay. And where was I here? Think back. Where'd it go? There it is. Anyway, going forward, this one's expiring worthless today. And you can see I've got the full premium as profit. So basically I made 100% rate of return on that one. Well, that's the actual return from, not the investment, sorry. 170 divided by 330, I made a 51% rate of return. 52, we'll call it, we'll round up. So it's not as high profit and not as high of a rate of return, but what if we didn't have that huge move up? What if we only moved up a bit, right? If we ended up getting out here, obviously this worked out really well with the earnings, but if it hadn't, we could have been in a big problem here, a big, bad situation with volatility collapsing like that, especially if prices didn't move far enough and fast enough. And that's why I probably should have taken into account the dividends, not dividends, the earnings releases coming out there. So not the best example because obviously this moved up greatly, but if it only moved up a little bit, we could actually change this now. That was on May 2nd. Earnings came out on what day here? Yeah, May 2nd, it looks like. So if we wanted to do this on May 2nd, excuse me, actually, let's see what it would have done on May 3rd. Going back once again to think back. And we're only going to May 3rd, so I could have actually chosen those options, May 3rd. Take that to May 3rd. And again, we were sitting at about 167. I could sell to 167, 165. Come on, May 3rd. And the profit was $63, but actually by the time we got out, we would have kept 100% of the premium, which is $110. So again, we would have had to put up a deposit, a margin deposit to make that $110. And that would have been $390. There's between, oh, actually, I'm sorry, I take that back. The strikes are smaller. It's 167.50. 165. So it's only 2.5 minus 110. So we only had to come up with $140 to make 110. That's a 78.5% rate of return. Okay. Again, going back, and we're getting out on May 3rd with the earnings. If we did a long call instead, and let's see, I'll do May 31st because that has plenty of time left until expiration. But on the 19th, if we bought the call at around 165, there it is, about 765. Let's see how that fared when the volatility collapsed. Fortunately, it still made some decent money because of the price gap up, but the day before that gapped, you didn't make much, 67.50. So without that big price gap, or what if the earnings were bad and it went down? If you wanted to exit before the expiration, the volatility collapsed so much, even though prices might have moved. Where were they on that day? Oops, wrong one. On the 2nd, yeah, it didn't move up as much. Even here, what was that? The 29th. Analyze. Let me see on the 29th. There was pretty good, again, because the price had moved enough, it overcame that falling of the volatility. But if you didn't exit on the right day, you know, how many of you would have looked at this saying, oh, I made 365. And then the next day, it's dropping down 117, dropped down to 67. How many of you would have been pretty scared and possibly gotten out with that 67, knowing you had almost $400 and now you've got less than 100 profit? Psychologically, it obviously would scare some people. And watch what happens if you don't get out in time. This one actually did go in the right direction. you can see if you held on long enough, you actually made a lot more because, again, the gap up on those earnings. But if the gaps were to the downside, if the earnings were bad, you would have obviously lost the premium you paid. And the volatility, like I said, when the volatility drops, it can really affect price, because on that time, excuse me, from that time, entering here, exiting right before the earnings release, you can see volatility was dropping and price didn't move far enough to overcome that. So you definitely want to pay attention to that. You can get crushed if you pick the wrong option. You typically want to buy options when volatility is relatively low and you're expecting it to rise, so that way you'll also get a big movement in price. If volatility is already high and expected to decline, that means the price movement might start to slow down as well. And that means that you're probably better off selling the options, allowing them to crumble in value and giving you better probability of return. So it's not just the amount of return you get, but also the probability of that return happening. And like I said, there's several tools out there that you could look at. I used to look at iVolatility. I don't know if they used to have a free way of getting in there from NASDAQ.com. I don't know if it's still there or not, if they took it away. Let's see. If you look for a symbol, I'll do NVIDIA. It's on my list there. And let's see. Option chain. I don't know if they have it still. It used to be, there's a website that you have to subscribe to called iVolatility.com. And you used to be able to get into some of the information by going here to the NASDAQ and then looking for the volatility information. I don't know if it's still here, though. It looks like it's gone. Option Greeks, that's related pages. So yeah, I haven't looked at this in a while, but that would also give you the average versus where the implied volatility happens to be currently. And yeah, I'm not seeing that. Oh well, that's a shame, because it was pretty cool. But like everything, they ended up because it was so good, you could make money off it. So they ended up doing that there, giving you a subscription for it, I guess. So anyway, but even without that, you could still go into different platforms. And again, you could search for high volatility or low volatility. And on TradeStation, I've got scanners set up where I can actually scan right here, implied volatility greater than average or implied volatility less than average. And I can search to see if we happen to have implied volatility for the options much lower than the average or above. If they're lower, I typically look to buy. If I go above, I look to sell. So that's one of the reasons why I may look to buy or sell. And again, it's all about probability of price movement as well. I need that price movement if I'm doing any kind of debit strategy. If I'm credit strategies, I want very little price movement or movement in my favor and have that higher probability. See, wouldn't it be better to pick a delta of 65 or better to ensure you're picking the right option? No, not necessarily. What if I want prices to stay between an area? I want basically a neutral strategy, which is almost no delta, right? So if I'm looking for prices to stay between 52.18 and 51.64, actually we'll do 80 and 20. So if I go to SPXW.X, again, the S&P 500, 0 DTE, if it loads, I got too many things going. That's the problem. There we go. So 0 DTE, I was doing 51.80, sell, buy the puts below. And I said 52, what? 20. Again, this is not a recommendation by any means, okay? I'm not doing enough analysis on this. And whoops, didn't do 25. There we go. So I've got an iron condor, I think. Let me make sure it's right. Oh no, got one wrong option in there. Which one did I miss? The put. There we go, iron condor. So what is my delta now? Almost nothing. Why? Because this profits if prices stay in a range and doesn't move much. It's got a little bit of a bearish bias, but very little. I make profit pretty much if time decays and or if volatility drops, because this is a debit strategy, right? I'm collecting premium. And let's see. Yep, there it is. As long as it stays between my strikes, I can't keep the premium. And I do have much more risk, obviously. Talking about buying an option, not just a call or put. The problem with buying an option that's in the money, and what you're referring to, if you have a 65 delta, you're buying deeper in the money. You're going to pay more for that, and you're not necessarily going to get the return for it. So if you buy deeper delta, instead of this 52, you go to 62 or 71, you're paying more for that option, and you need an even bigger move in order to profit. So is that good? Not necessarily. You may not get the same kind of return you want. I guess I can go back to toss, and I got to wrap up here pretty soon. But again, if I go think back, again, we bought that option, Apple 165, and on that earnings expiration, actually, I'll go to today. And we made 1750 on that. May 31st is expiring. Well, actually, we wouldn't have bought that one. Sorry. I was using July for that. Still making money, 1617. But that at the time, excuse me, time of entry was pretty much an at the money option, right? 165. Where's the delta? There it is. Yeah, 60. Now, if I went a little bit deeper, 68 to get above. Let's see, is that one? Yes, 160 because it's $5 strikes there. Would that be better? Well, I made 1792, but my cost was higher. So I made 1792.5. Oops. 1792.5 divided by 1380. And my rate of return was actually almost 20%, more than 20% less than if I did the 165. I made 1625 because my cost was lower, right? So my rate of return was better by doing the at the money option versus the deeper in the money option and getting a delta of 65. 1627 divided by 10. Was it 15? No, 1065. See, 152 versus 130% rate of return. So I got 22% better rate of return by using an option that was at the money. I don't have to tie up as much capital. Was it about 1,065 versus 13, right? Or 1,400 almost. Now, what you also want to avoid is going deep out of the money as well. A lot of people try to go really cheap and buy deep out of the money, thinking, oh, well, prices should move up far enough that I'll profit by then. Not always. Again, volatility and other things like time decay can hurt you. You can see that they paid $181. Yeah, they made $462.50 this time because, again, there was that big gap in the right direction. But if that gap did not happen, if it didn't go far enough, fast enough, I have to change the option strikes, another thing. But if I go back to the third, you can see as the volatility dropped, that got crushed, even with the initial gap. So you spent only $177, but you only made $47.50. It's less than 100%. So don't try to buy what they call lottery tickets. That's deep out of the money where you have very low delta just because it's cheaper. And you don't want too much delta because your rate of return starts to suffer because you're using too much capital to get into the position. So it's kind of a fine balance there. And, those are some of the things that I cover in a lot of my education. As I mentioned, SPX cash flow, that program really focuses more on the sell side. So I talk about vertical credit spreads and how to use some of the charting to figure out the right opportunities in the markets. And I have my strategy kind of labeled out there as well. And then the documentation that kind of supports all that. And there's bonus videos where we meet on a regular basis as well and do Q&As. We got to get that newest one up there. So if you're interested in more information on that, let me know. You can email us at support@wealthbuildershq. I got to get going. I got to take care of a bunch of things, but hopefully I was able to give you a little bit of information about, whether you should be buying or selling options. It's a function of where prices are going to go. Do you have the higher probability or lower probability? Will prices move far enough and fast enough? Time is a factor as well as volatility. Buy low, sell high works for volatility as well as it does for prices of securities. So yeah, thank you very much. Happy trading to you too, Brenda. Take care, everyone. Hopefully I'll see you again soon. In one of my programs. If you're interested in options or learning more, let us know. Support@wealthbuildershq.com. You can also join me at the SPX Cash Flow Secrets or any other programs as well. And we'll be back again next week with some more education. So until then, take care, everybody. Thank you, guys. Appreciate it.